in this section, we're looking at leases. Now, a lease is a contract between the lessor and the lessee. With the lessor, the landlord, he owns certain property, he owns certain PP&E. So let's put that here. So the lessor or the landlord, he owns certain PP&E. Now he gives the lessee or the tenant the right to use and possess this piece of PP&E for a specified period of time in return for periodic payments or rents. So guys, it's the landlord's or the lessor's property which the lessor is giving to the lessee to use in return for rent. So for lessee, every period they're going to have rental expenses. They're going to be paying out rent to the landlord, to the lessor. For the lessor, the landlord, every period he's going to have rental income. So cash is going out from the lessee to the lessor. Why? Because the lessor is giving the lessee the right to use and possess his PP&E. So this is sort of a true rental, an operating lease. So looking at Walmart out here, let's say Walmart, they want a piece of space in a shopping mall. They really like it. They want to set up a new store. They approach the owner of the shopping mall, the lessor, and tell him, we want the space for the next 5 years. In return, the lessee, Walmart, is going to be paying out rents to the landlord, to the owner of the shopping mall. So let's put journal entries and have all the conditions, all the specific cases for operating leases. So we're looking at both the lessee and the lessor. So every period, they're going to be periodic rents. For the lessee is going to be rent expense debit, which goes into the income statement. This one would go to the income statement, and cash credit. For the lessor, cash is going to be coming in. So the lessee is paying out cash to the lessor, and it's rent income for the lessor, which again goes to the income statement. Now, getting back to our dashboard. So we have lessor, he owns the PP&E. So he's going to be depreciating this PP&E over its useful life. Guys, remember depreciation from FAR 3? So along with rental income, he is going to have a depreciation expense. So this was for this tangible asset. Now in FAR 3, in intangible assets, we also talked about leasehold improvements. So if the lessee, the tenant, has done certain leasehold improvements. So I give you this example of this piece of board. If this board is fixed to the wall so that I, the lessee, I, the tenant, cannot take it away when I leave this place, it becomes a leasehold improvement, an intangible asset, which is amortized over the shorter of legal or useful life. So if the lessee has done certain leasehold improvements, that becomes an intangible asset on the lessee's balance sheet, which is amortized over the shorter of legal or useful life. PP&E by the lessor, depreciated. Leasehold improvements, amortized. So let's put it down here. The lessee, any leasehold improvements. For the lessor, so this is amortized. Lessor, the PP&E, that's depreciated. Now, you also often have this concept of rent-free period or uneven lease payments. So let us say when the lessee is leasing out the space from the lessor says, I'm going to give you a certain rent-free period. So let's say when Walmart went out to lease that piece of space in the shopping mall for 5 years, the lessor, he said, I'm going to be giving you first 6 months rent free. So let's say $10,000 of rent each year for the next 5 years, of which first 6 months rent free. So let's put numbers out here. So rent free period example, and let's say years 1, 2, 3, 4 and 5, and the dollar rent for each year is $10,000. Now for the first year, the lessor, the landlord gave the lessee a rent-free period of 6 months. So the lessee would pay a rent of only $5,000. Over 5 years, the lessee has paid $45,000. Now guys, think about it. On the lessee's income statement is going to be $5,000 expense in year 1, and from year 2 it's going to be $10,000 of expense each year for the next 4 years until year 5. Now this is not perfect matching. So less expense in year 1, more expense in the remaining years. Similarly for the lessor, it's going to be less income for year 1, more income for the remaining years. So what we do is we even this out. So the rental expense for the lessee was $45,000 for 5 years. Now what we're going to do is, what is it per year? We're going to do $45,000 divided by 5 gives us $9,000 each year. So on the accrual basis, the rental expense for the lessee each year is going to be $9,000. Now wait a minute. In year 1, the lessee paid only $5,000, but the expense on the income statement for the lessee is going to be $9,000. The way we're going to account for it is like this. So let me have this rent free period. So if I look at year 1, now we're saying rent expense here is $9,000. But the cash that goes out, so let me put this rent expense in blue pen. But the cash that goes out is only $5,000. The remaining we would create an accrual account, rent payable of $4,000. Though cash went out only $5,000, the expense on the lessee's income statement is $9,000. Now from year 2 to year 5, now again, rent expense each year for the lessee is going to be $9,000. But the cash that's going to go out every year for 2, 3, 4 and 5 is going to be $10,000. So what you're going to do is the rent payable account which is created, the accrued rent account, is now going to be debited. So every year the rent payable account is going to be debited $1,000. So across 4 years the rent payable becomes 0. Now similar thing for the lessor. The cash coming in year 1 is only $5,000. But the rental income is $9,000. So again, similar, cash going out from here is 5,000. Cash coming in here, 5,000. Rental expense here, 9,000. Rental income, $9,000. So here you have a rent payable of $4,000. There we're going to have a rent receivable, accrued rent receivable of $4,000. Years 2 to year 5, again, the rent income amount, that's going to remain at $9,000. Guys, we are following the matching concept. But the cash that's coming in is going to be $10,000. So this rent receivable $4,000 is now going to be credited each year for $1,000. So basically, as you can realize, this is uneven lease payments. It's not $9,000 each year, it's $5,000 in year 1 and $10,000 from years 2 through 5. We even it out. We take it as $9,000 each year. This is the matching concept. Now, you have a few more variations for operating leases that you better be aware of. Let's say the lessee pays the lessor certain lease bonus initially. They're very excited looking at this piece of PP&E and they pay certain lease bonus. Now, that lease bonus becomes a prepaid rent, a deferred expense here, and a deferred revenue for the lessor, which is amortized straight line over the life of the lease. Now, there could be cases of security deposit paid by the lessee, the tenant to the landlord. Now, if it's a refundable security deposit, that deposit is an asset for the lessee, it's a liability for the lessor, because at the end of the lease term, the lessor needs to refund it back, refundable security deposit. However, if the deposit is non-refundable, then in that case, this becomes a prepaid rent or prepaid asset for the lessee and a deferred revenue for the lessor. Now, that is recognized as revenue by the lessor only when it is earned. So, a non-refundable security deposit may generally be considered earned by the lessor at the end of the lease term. One more thing, okay. Let me also talk about initial lease costs. Let's say the lessee and the lessor, they are entering into this contract, this lease. Now, when they're entering into the contract, they might have certain initial lease costs, something like, let's say, broker commissions, legal fees. All that is expense for the lessee on their income statement. For the lessor, what they do is this one is amortized over the life of the lease. Now, we'll talk about direct lease costs versus executory costs. So, I give you direct lease costs, something like broker commissions, legal fees. That we said for the lessor, we're going to amortize over the life of the lease. But if it's executory costs, let's say the lessor is still paying repairs and maintenance for the property. He's still paying the property taxes. All those executory costs are expensed by the lessor as incurred. Once again, direct lease costs amortize over lease term. Executory costs like taxes, repairs and maintenance expense as incurred. So I've given you a lot of content on operating lease. Let's get to the book. We got a lovely table there. We're going to show you all this. On page 26, we're looking at leases. It says lease is a contract between the lessor and the lessee, which gives a lessee rights to possess and use the lessor's property for a specified period of time in return for periodic payments. So right there, lessor equals landlord, lessee equals tenant. Turn to page 27 where we're looking at operating leases. Right there, rental agreement. And then we are now comparing accounting by lessee for the operating lease and accounting by lessor for the operating lease. So put a box around lessee and another box around lessor. Looking at the journal entries, for the lessee, it's a rental expense each period. So highlight rent expense. For the lessor, it's rental income each period. Highlight rent income. Under lessee, highlight leasehold improvements made by lessee amortized over the lower of remaining lease life or useful life. Under lessee, also highlight total rent expense payable for the entire lease term is divided evenly. So if there are uneven lease payments or free rent period, make sure you divide the total rent expense payable for the entire lease evenly over the lease term. And that also applies to lessor. So highlight total rent income receivable for the entire lease term is divided evenly. Now, if there is a lease bonus, under lessee, underline deferred or prepaid rent expense. Under lessor, underline deferred or unearned revenue. So for both lessee and lessor, the lease bonus is amortized using straight line method over the lease term. Now, if there is a rent paid or received in advance, for lessee, underline deferred or prepaid rent expense. For lessor, underline deferred or unearned revenue. For non-refundable security deposits, for lessee, underline deferred or prepaid rent expense. For lessor, underline deferred or unearned revenue. Unless it's considered earned by the lessor, generally at the end of the lease term for non-refundable security deposits. Now, looking at the initial cost incurred, for lessee, we know it's expense as incurred. For lessor, highlight initial direct lease costs like broker commissions, legal fees, etc. amortized straight line over the lease term. Also highlight executory costs like taxes, repairs and maintenance, insurance are recognized as incurred. Now, when I define leases, I said this PP&E is the lessor's property, the landlord's property, which the lessor leases out to the lessee, the tenant, for a lease term in exchange for periodic lease payments, periodic rental payments. Now, what if the lease terms they're made in such a way that though the lessor, the landlord owns this PP&E on paper in form, it looks like the lessee has actually purchased this piece of PP&E from the lessor. So, in form, the lessor owns the PP&E, but in substance, it looks like the lessee owns. Such leases are called capital leases because they are no longer operating leases, true rental. So, your criteria for determining whether it is a capital lease is owns. The question that you want to ask is, does the lessee owns this PP&E? If yes, it's a capital lease. So, owns is 4 criteria. If any one of these 4 criteria is met, it's no longer an operating lease, it's a capital lease, where though the lessor owns the PP&E in form, in substance, the lessee owns. Now, the O of the owns, this stands for ownership transfers at the end of the lease. So, you have a contract between the lessor and the lessee, and one of the terms on that contract, on that lease, is at the end of the lease term, this PP&E, the ownership would transfer from the lessor to the lessee. So, that becomes a title transfer and we account for it as a capital lease. The W criteria, this is written option for bargain purchase. So, a written bargain purchase option. Now, if the lease terms are such that at the end of the lease, the lessee has the option of purchasing this PP&E from the lessor at a throwaway price, at a bargain price, let's say a price of less than 50% of the assets then fair value. In that case, we account for it as a capital lease. Think of it, the lessee, if he's getting to purchase the PP&E at a bargain price, at a throwaway price, he's not going to leave it. He is basically going to own this PP&E at the end of its life. So guys, the first case, ownership transfers at the end of the lease. So no matter what, after the lease term, the lessee would own the PP&E. The second case, at the end of the lease term, the lessee would have to give a petty amount for this valuable piece of PP&E. The third criteria, N, this stands for 90%. So we would say here that the present value of minimum lease payments is greater than or equal to 90% of the fair market value of this PP&E. Guys, as you can understand, if this is such that the present value of the future payments that the lessee is going to pay the lessor is so high that it's more than 90% of the PP&E's current fair value, now this would mean that the lessee is committing to pay a lot of money for this PP&E over the life of this asset, over the lease term. Now, in that case, we would say that though the lessor owns this PP&E in form, actually in substance, the lessee is buying the PP&E from the lessor. The last criteria, S, this stands for 75% of life. So, if the lessee is leasing this piece of PP&E for 75% or more of its economic life, we account for it as a capital lease. Basically, the lessee is going to use the asset for most of its life. So guys, I've given you 4 criteria here: O, W, N and S. If any one of these 4 criteria are met, title transfer, bargain purchase option, present value of minimum lease payments is more than or equal to 90% of the asset's current fair market value, the lease is for 75% or more of this PP&E's economic life. In that case, we say PP&E, that's on the lessor's books, yes. But in substance, the lessee owns this PP&E. That becomes a capital lease. On page 28, we are looking at capital leases. Right there, substance over form. It says lessee must meet just one condition to capitalize. Circle 1. On the first bubble, write O, highlight ownership transfers at the end of lease and write title transfer. Next bubble, write W, highlight written option for bargain purchase and write there bargain purchase option. Third bubble, write N, highlight 90% of lease property fair value is less than or equal to present value of future minimum lease payments. The fourth bubble, we have S and highlight 75% of asset economic life is being committed in lease term. So for a lease to be classified as capital lease, the lessee must meet just one of the owns criteria. We've been doing a lot of serious studies. It's now time for some entertainment. It's time for some magic by your very own CPA magician, Varun Jain. Guys, every magic trick consists of 3 parts or acts. The first act is called the pledge, where the magician shows you something ordinary, like a deck of cards, a bird or a girl. As a CPA magician, I show you this PP&E on the lessor's balance sheet. Then we have the second act called the turn, where the magician takes the ordinary something and makes it do something extraordinary. But you won't clap yet, because making something disappear just isn't enough. That is why every magic trick has a third act, the hardest act, the act we magicians call prestige. This is the part with the twists and turns where you see something you've never seen before. I'm sure with my lovely magic trick, the concept of capital leases has become so much more interesting, and you're so keen to learn all about accounting for capital leases in the books of the lessee and in the books of the lessor. Now, before we move on, let's take a step back and recap on all that we have learned till now. So we know that the lessee, they're going to be accounting for a lease as a capital lease if any one of the owns criteria is met. And that's why we say the lessee actually owns the PP&E in substance. Owns criteria. Now, looking at this from the lessee's perspective, let's talk about Walmart, the big retailer, which also leases a lot of space. So, if Walmart has a lease with a lessor such that ownership of the property transfers to Walmart at the end of the lease term, that's a capital lease. If Walmart has a bargain purchase option, even then it's a capital lease on the books of Walmart. Now, if Walmart is making a lot of payments such that the present value of all future minimum lease payments is greater than or equal to 90% of the property's current fair value, even that's a capital lease. Let's say they're leasing out a piece of property which has got a life of 50 years and they're leasing for 40 years. Greater than or equal to 75%? Yes, it's a capital lease. So any one of these four criteria needs to be met for lessee to classify a lease as a capital lease. If it's not a capital lease, then it's simple and easy. It's a true rental operating lease. Now, we've looked at a magic show for capital lease where we saw that the asset was no longer there in the books of the lessor. It moved to the books of the lessee. So this one disappeared and then it came back. So guys, though the lessor continues to own the property in form on paper, in substance it's now the lessee's property. But the lessee is not paying up all the cash. So it's sort of buying the property, but it's not paying up all the cash right now. The lessee is telling the lessor, I'm going to be paying you lease payments over the lease term. So what we do is we capitalize the lease liability. We capitalize all the payments that the lessee is going to be making to the lessor over the lease term, the future minimum lease payments. So this becomes lease liability here. So guys, as you can understand, we're building up an asset and a liability on the lessee's books. Now, looking at the lessor's books, PP&E, that's disappeared from the books. But now they have a lease receivable. So as you can understand, it's a payable, a liability for the lessee, a receivable, an asset for the lessor. Now looking at the income statement. Now in an operating lease, we said that the lessee, they're going to have rent expense. Now if it's a capital lease, they don't have a rent expense. Instead, they have interest expense. So we're going to be amortizing this lease liability, which is at present value, and on that amortization schedule, we're going to be calculating interest expense that the lessee would expense on the income statement over the lease term. Now PP&E, that's moved from the lessor's books to the lessee's books. So who's going to depreciate it now? Simple and easy. The lessee would depreciate because now they have the PP&E on their books. So they're also going to have depreciation expense. Now looking at the lessor, no longer rental income. Depreciation expense, they naturally will not have depreciation expense because the asset is not on their books. They're going to have interest income. Now, from the lessor's standpoint, we're going to learn about two types of leases. Number one, direct financing leases where the lessor would only have interest income. We'll also look at sales type leases where the lessor would have interest income plus or minus gain or loss on sale. So we'll come to that, but for now, let's focus on the lessee's accounting for the capital lease. And your question is, does the lessee owns the PP&E it has leased from the lessor? If yes, take the PP&E to the lessee's books, get this lease liability up and running. So let's do that on the other side of the board. You're going to debit PP&E and you're going to credit a lease liability. So we're building up an asset and a liability. Now we're going to be calculating this at present value of future minimum lease payments. So let us say if it becomes a capital lease because of the O criteria, then the future minimum lease payments are the lease annuity that's being paid out, the periodic lease payments plus any required buyout payment by the lessee. So all that is present valued. If it's a W criteria, then we're looking at the annuity lease payments, periodic payments plus the amount of this bargain purchase price. So all that is present valued to current date. If it's the N or S criteria, in that case we're simply looking at the present value of the annuity, the periodic lease payments. Now when you present value future payments, you're going to be using a discount rate, and the discount rate that we use here is the lower of the rate implicit in the lease. So the rate implicit in the lease is actually the lessor's rate. Now if that is not known, we could also use the incremental borrowing rate of the lessee. So if the lessee goes out to the bank and takes additional loans, what's the incremental borrowing rate? If we know both of them, then we're going to use the lower of the two. So the discount rate that you're going to use for the present value is the lower of the lessor's rate, that's the rate implicit in the lease, or the lessee's incremental borrowing rate. Now once you've created this asset and this liability, that's your step one. Step two is you're going to be amortizing this liability over the lease term. Step three, you're going to be depreciating this PP&E. Guys, the lessor does not have the PP&E on its books now. It's gone off the lessor's books into the lessee's books. So naturally the lessor, they are not depreciating it anymore. The lessee would be depreciating it. So if it was an operating lease, there would be nothing on the lessee's balance sheet. Because it's a capital lease, you have an asset and a liability. So guys, you understanding and you're set for all the fun that we're having with capital leases. And now let's look at a problem that you have on your book to understand the three journal entries I gave to you. Number one, create the asset and the liability. Number two, amortize the liability. Number three, depreciate the asset. That's all you do in accounting for capital leases in the books of the lessee. So on this example, you have on 1st Jan 2011, lessee company leases from lessor company equipment for 5 years at $25,000. So 5-year lease, $25,000 payable at the beginning of each year. Guys, remember we said ordinary annuity, that was payments at the end of each year, annuity in arrears. Now beginning of each year, this is an annuity due. Then it says title of the asset transfers at the end of the lease. Now I know what you guys are thinking. Title transfer at the end of the lease. Is it an operating lease or a capital lease? Naturally it's a capital lease because the O criteria is met. So any one of these 4 criteria needs to be met for the lease to be classified as a capital lease in the books of the lessee. So now since the title transfers at the end of the lease, we know we're working on a capital lease. The asset life is 10 years, so the equipment is going to last 10 years with incremental borrowing rate of 10%. So they've given us the incremental borrowing rate. So the lessee's incremental borrowing rate 10%. Lessor's rate we don't know. So we're going to use this 10%. If we know both, we're going to use the lower of the two numbers. Guys, L for leases, L for lower. Good way to remember. Now looking at part 1 of the solution, you capitalize the asset and the liability. So you have $25,000 payable at the beginning of each year, annuity due. They've given us the present value factor for annuity due 4.16987. So $25,000 into this present value factor gives us 104,247. So that's the capitalized asset and liability. So 104,247. Now to amortize the lease liability, we're going to be creating an amortization schedule. Now I'm sure you guys are all experts in amortization schedules by now. We've done that in bonds, we've done that in debt restructurings, and now we're doing that in leases. So it's simple, easy, and gives you easy goodie marks on the CPA exam. So let's do it again, amortization schedule. So I'm looking at the date here, date of period. I'm looking at interest. Now interest, what's the rate here? 10%. Then we're looking at the minimum lease payments. We're looking at the plug, which is basically the lease liability amortization. And the last column we know, that's the carrying value. The carrying value is 104,247. Now this lease liability would need to be amortized over the lease term. So at the end of the lease term, would the lessee have any more liability? No. So this lease liability number moves from 104,247 at the beginning of the lease to $0 at the end of the lease, because then the lessee has no more liability. So that's what our amortization schedule is doing, getting this to 0. Let's see how it happens. So on the first date, now payments here are made at the beginning of each period. So on day 1, when they just have an agreement, they just shake hands, have the contract done, the lessee says, here's your first $25,000. Would you have any interest right on that day? No, you need time for interest to accrue. So there is 0 interest, minimum lease payments, that's $25,000. 0 minus $25,000 gives you amortization of $25,000. So on day 1, the carrying value of this liability moves down from 104,247 to 79,247. Then the next payment date is 1st Jan 2012. It's first date of each period. Now again, the minimum lease payments, that's going to be $25,000. The interest expense would be 10% of this balance carrying value. 10% of 79,247 would be 7,925. The plug, that would be amortization of lease liability. So guys, on 1st Jan 2012, the lessee is making the second payment of $25,000 to the lessor. Of the $25,000 that the lessee is paying, $7,925, that's interest expense. The remaining is a reduction of this liability and amortization of the liability by $17,075. So now the carrying value of the liability comes down. The new carrying value is $62,171. So again, looking at the beginning of the third period. So again, the lessee takes $25,000 in cash, goes to the lessor, gives it to him. So you're going to have interest expense 10%, 6,217, minimum lease payments $25,000. So of the $25,000 that the lessee gave to the lessor on 1st Jan 2013, 6,217, that was interest expense. The remaining 18,783 was an amortization of lease liability. So now the lease liability comes down further. The new number is 43,389. Again, the story goes on till you get to the end of the lease. So 10% of this, 4,338, so this will be 4,339. Payment is $25,000. The lease liability amortization gives you 20,661. The new carrying value is 22,727. So now the lessee has made payment 1, payment 2, payment 3, payment 4. The last payment, the 5th payment, is coming up on 1st Jan 2015. 10% of this gets us to 2273. I'm right. Good at math. The minimum lease payment, that's fixed. That's $25,000 each period. Guys, look at this. $25,000 is fixed. That's decided. That's signed off on the lease. Of the $25,000 that the lessee is paying to the lessor on 1st Jan 2015, we are saying 2,273. That's interest expense. The remaining is amortization of the liability. So the remaining 22,727 is the lease liability amortization, such that the lease liability becomes zero, because there is no more lease payments that the lessee would have to pay to the lessor. That's the end of story. Lease liability finished. So guys, that's your amortization schedule. If you remember, when we looked at a bond amortization schedule, we moved from the bond carrying value at issuance to the bond face value at maturity. In case of leases, we are moving to the carrying value of the lease liability to zero, because there's no more a liability. Nothing else needs to be paid by the lessee to the lessor. So you've done this lovely amortization schedule. Now let's look at the journal entries that we're going to have here. The first journal entry, very important: create the asset, create the liability. Guys, if it was an operating lease, there was no headache, there was nothing doing here. But because it's a capital lease, one of these four criteria is met. In this case, title transfers. So you're going to have to create the asset and the liability on the lessee's books. Amortizing this liability now. So first, we're going to be looking at interest expense to interest payable. I'll tell you why I'm doing this. And you're going to have interest payable and lease liability, and cash is going out. So when I'm looking at 1st Jan 2011, on day 1, there's no interest expense. But then the lessee is giving $25,000 of cash to the lessor. Now that's simple amortization of the lease liability. Lease liability comes down. So entire $25,000 goes to the lease liability, nothing for the interest. Now, if you understand, though the payments are being made, the next lease payment is going to be made on 1st Jan 2012. The interest expense of $7,925 is actually for the year 2011. So on 31st December 2011, you have an accrued rent expense. So guys, this interest expense 7,925 is for the year 2011. But it's not paid out on 31st December 2011. It's paid out on the next day, 1st Jan 2012. So as per accrual accounting, we learned matching. We're going to have this interest expense right on 31st December 2011. So this number is 7,925. But it's not paid out yet. It's accrued. Cash is to be paid out. It's paid out on 1st Jan 2012, right the next day. So you're having the New Year's Eve here, parting out, next day come and give the cash. That's what you're doing here. 7,925 interest payable, it's now paid out. 7,925. The total cash that the lessee pays is $25,000, of which 7,925 is interest, remaining 17,075, that's lease liability amortization. Similarly, story goes on. So if you're looking at the New Year's Eve on 2012, the interest expense is 6,217. Payment is made on 1st Jan 2013. So you have 1/1/2013. $25,000 cash is going out from the lessee to the lessor. Of this, 6,217 applies to the interest payable. Remaining 18,783 is lease liability amortization. So this number, $25,000, this is a fixed number, the annuity that goes out at the beginning of each period. So if you look at the fourth period now, 12/31/2013, The interest expense, that's 4,339. Now this is not paid out on 31st December 2013, it's accrued. It's going to be paid out on 1st Jan 2014. Happy New Year. So the interest payable 4,339, cash goes out $25,000. The plug of 20,661, that's to lease liability. Now looking at the last year now, 31st December 2014, this is 2,273 of interest, and the last Happy New Year 2015, you have this 2273 being debited, $25,000 cash going out, the plug 22,727 to lease liability. So $25,000 beginning of each year for 5 years. You have interest expense over for 2011, 12, 13 and 14. You have the lease liability being amortized. So guys, if I do this, $25,000 plus 17,075 plus 18,783 plus 2661 and 22,727. So if I add up these four numbers, it's going to calculate to 104,247. So the credit, the lease liability that we had created at the beginning of the lease, when the lease was signed, is amortized over the lease term, such that at the end of the term, it's zero. And during the lease term, the lessee is having interest expense. So in our example, the lessee is having an interest expense of, so let's do the totals here. So the total interest expense over 5 years is 20,753, and the lease liability amortization, that's 104,247. So what we are saying is, over the course of the lease, the lessee has made a total payment of $125,000, 5 into 25 to the lessor. Of the $125,000, 20,753 is interest expense over the 4-5 years. And the balance, 104,247, is the lease liability amortization, which goes on from this number to zero at the end of the lease. So guys, that was step 2. Pretty lengthy, but I'm sure fun and exciting. So you've created asset and liability. You've amortized the asset. So if you look at this journal entry, so interest expense debit to interest payable. On the next day, Happy New Year, you have interest payable debit. So if you see, this is actually a wash. So you're going to combine these two journal entries. It's basically interest expense debit, lease liability debit, cash goes out. So the cash that you're paying out, $25,000, gets applied to interest and to the lease liability amortization. So this $25,000 is sum of these two. So if you look at $25,000 on 1st Jan 2012, that's a sum of 7,925 interest, and the remaining 17,075 goes to lease liability amortization. Similarly, if you look at, let's say, 1st Jan 2014, $25,000 is a sum of 4,339 interest expense plus 20,661 lease liability amortization. So that's all good. So this liability that we had on the lessee's balance sheet is now amortized. Step 1, create these two. Step 2, amortize this liability. Step 3, depreciate this asset. You're also going to have a depreciation expense. So let's do that, the third journal entry here. Now this says you're going to be having, okay, the lease term is 5 years, but the life of the asset is 10 years. Now what's going to happen is, after 5 years, the title of the equipment is going to transfer from the lessor to the lessee. The lessee is going to use this asset for the entire 10 years. Though the lease payments are going only for the 5 years, usage of the asset is going to be across 10 years. So guys, it makes sense depreciating this asset over 10 years. So what we're going to do is, let's say if you're doing straight line, we're going to divide this number by 10. So 104,247 by 10 would be 10,425 each period. So you're going to have depreciation to accumulated depreciation. I'm sure you remember this concept from part 3, fixed assets. Each period, the number is going to be 10,425. And this is going to be across 10 years. So every period, if it's straight line method. So guys, create asset and liability, amortize liability. So let me write it. So create asset and liability. Number 2 is amortize this liability. 3 is depreciate the asset. So that's exactly what you're doing in case of a capital lease. Now for all of you in class who look a little confused with this concept of capital lease, let me make it very simple for you. Let us say if this lease was not a capital lease. So get back to the dashboard. So let's say if this lease was not a capital lease, what would have been the total rental expense of the lessee? It would have been $25,000 rent each year for 5 years, $125,000, correct? So if this lease was an operating lease, not a capital lease, then the rent expense over 5 years would have been $125,000. Or rather, let me use a blue pen for this. It would have been $125,000 if it was a capital lease, if it was an operating lease. Now we are saying this is not an operating lease, so there is no rent expense. Instead of that, we're going to have interest expense and depreciation expense. Interest expense, the total amount is $20,753. The depreciation expense, so interest expense is over 5 years. Depreciation expense, that's over 10 years. And the total amount of depreciation is $104,247. So guys, what we're saying is, if it was an operating lease, the rental payments over 5 years would have been $125,000. But it's not an operating lease. It's a capital lease where you instead have interest expense and depreciation expense. Interest expense over 5 years of the lease, that's $20,753. Depreciation expense over 10 years of the asset is $104,247. So each period it's $10,425 over 10 years. Now total of $20,753 and $104,247 is $125,000. So guys, as you can understand, nothing has changed. It's just the way it appears. So in an operating lease, the expense here on the lessee's income statement would have been $125,000. It's the same number in case of a capital lease. Just that instead of being called a rent expense, it's now interest expense and depreciation expense. Now you created this asset and this liability on the lessee's balance sheet. This liability, this number becomes 0 at the end of the lease term, at the end of, let's say, 5 years. PP&E, this number also becomes 0 at the end of the asset life. So you create the asset and liability, and again at the end of the lease term, lease liability vanishes. When the asset is no more, asset life ending in case of O&W, PP&E vanishes. So guys, it's just the same. If you understand operating leases well, let's try to connect it back, and we see that capital leases is a step ahead, where we're trying to show that yes, we know that the lessee, they don't own the asset, but the terms are such that the lessee seems to own the asset in substance. Get it on the lessee's books, and then the expense, the total expense, the classification changes, the number remains the same. It's still a total of $125,000. I've spoken a lot. Let's get to the book, do a highlighting, and I'm sure you're doing really good with capital leases. You know, it's a capital lease when the lessee owns. On page 29, we're looking at lessee capitalization rules. We know that in a capital lease, the lessee is going to capitalize the leased asset as PP&E on the balance sheet with a corresponding lease liability. Now the leased asset is recorded at the lower of cost or fair value. Now we just looked at how to calculate the cost. Highlight present value of future minimum lease payments. The minimum lease payments equals periodic lease payments plus any required buyout or guaranteed residual value or any bargain purchase option. Now let's understand minimum lease payments using our own criteria. For the O criteria, highlight ownership, title transfer. The present value of future minimum lease payments equals the present value of the annuity payments plus the present value of required buyout. For the W criteria, that's a written bargain purchase option, the present value of future minimum lease payments equals the present value of the annuity payments plus the present value of the bargain buyout. Now, if the O and W criteria are not met, then we're looking at the N criteria. Highlight 90% equals present value of annuity payments. And for the S criteria, highlight 75% equals present value of annuity payments. So if the O and W criteria are not met and we are classifying it as a capital lease on the lessee's books because of the N or the S criteria, make sure you do not add any optional buyout. And right there, which is not a BPO, which is not a bargain purchase option. Now for the lessee, exclude any underlying executory cost. So if there are any repairs and maintenance, insurance or taxes paid by the lessee, make sure you write expense as incurred. Now to calculate the present value of future minimum lease payments, we need to know the discount rate. So highlight discount rate. Now this is the lower of, highlight rate implicit in the lease if known, and right, that is lessor's rate. Or highlight rate available in the market to lessee, not the bank prime rate. Now looking at the journal entries there, highlight PP&E leased asset debit and lease liability credit. And right there, journal entry number 1, recognize both asset and liability at the lower of number 1, present value of future minimum lease payments, and number 2, FMV, fair market value. So guys, as we know, the leased asset is recorded at the lower of cost or fair value. Cost we calculate using the present value of future minimum lease payments. On the next sub-bullet, write journal entry number 2 and put a box around amortize the capitalized lease liability. And you do that by effective interest rate method and underline at the rate discount rate used to compute the present value above. Right, amortize over lease life. So the lease liability is amortized over the lease life. And you're going to have an interest expense each period. So highlight interest expense and write I/S because that goes to the income statement of the lessee. Then we're looking at the third journal entry, right? Journal entry number 3 and put a box around depreciate the capitalized leased asset. Now this depreciation is by straight line method. Now in case the O or the W criteria is met, put a bracket and write depreciate over asset life. In case the N or the S criteria is met, put a bracket and write depreciate over lease life. Now as you can understand, if the O or W criteria is met, the lessee is actually going to own the PP&E over its entire life. But in case of the N or S criteria, the lessee is going to own it over the lease term. Journal entry there, highlight the debit depreciation and write I/S because that goes to the income statement of the lessee. And let's make a little note at the bottom of this page. Right, lessee expense on income statement. For operating lease, it's rent. For capital lease, it's interest plus depreciation. Turn on to page 30, where we're looking at the lessee's accounting for capital leases. So on 1st Jan 2011, lessee company leases from lessor company equipment for 5 years at $25,000, payable at the beginning of each year. Underline payable at the beginning of each year and write there annuity due. Title of the asset transfers at the end of the lease. So this is the O of the owns criteria met. Hence, this is a capital lease. We have the asset life of 10 years and incremental borrowing rate 10%. Now, looking at the solution, our first journal entry, right? Journal entry number 1, and put a box around capitalize asset plus liability. So the debit is to leased equipment and right there depreciate over asset life 10 years. Because this is a capital lease due to the O or W criteria, and if you remember, if it's O or W, depreciate over asset life. If it's not O or W, it's due to N or S, then you depreciate over lease life. Now in this case, 104,247 needs to be depreciated over 10 years, the life of the asset. For the lease liability credit, 104,247, write amortize over lease life, 5 years. And then we have our second journal entry, right? Journal entry number 2, and put a box around amortize the liability. Now here we have an amortization schedule being built up, and we're going to amortize the lease liability of 104,247 that we recognized in journal entry number 1. So put an arrow from the liability number 104,247 down to the amortization schedule. And looking at the schedule, the first column, that's the date or the period. The second column, highlight interest. Third column is the minimum lease payments, $25,000 each period. Fourth column, highlight lease liability amortization, where we amortize the lease liability of 104,247 that we recognized in the first journal entry. And the last column, that's for the lease liability carrying value, and highlight 104,247. Next row, looking at the interest column, we have $0, highlight $0 and write there day 1, because the lease payments are made at the beginning of each period. So you are having a $0 interest on day 1. And then we have interest amounts of 7,925, 6,217, 4,339 and 2,273. Put a bracket around all these 4 interest calculations and write total 20,753. So the minimum lease payments are $125,000, of which 20,753 is interest expense. The balance 104,247 is used to amortize the lease liability. Now move down on this page and let's look at journal entry number 3. Put a box around depreciate the asset. And looking at our depreciation journal entry, the debit is 10,425 each period. Right there into 10 years equals 104,247. And to understand the lessee's expense in this capital lease, let's draw a line on the bottom of this page. Right, depreciation expense 104,247 over 10 years, because that's the present value of the asset. So right, present value of the asset equals 104,247. And then we got interest expense of 20,753, that's over 5 years. And then the total is the lease payments of $125,000. So guys, if this was an operating lease, the rental expense by the lessee would have been $125,000. Now since this is a capital lease, there is no rental expense. Instead of that, we got interest expense of 20,753 and depreciation expense of 104,247. The total is still $125,000. That is the essence of a capital lease accounting by lessee. Now, we've been looking at accounting for capital leases from the lessee's perspective, and we know the lessee is going to classify a lease as a capital lease if any one of these four owns criteria is met. Now, for the lessor to classify a lease as a capital lease, not only any one of these four owns criteria needs to be met, but also there are two additional conditions. Number one, the collectibility of lease payments from the lessee should be reasonably predictable. And number two, the lessor needs to have certainty regarding any unreimbursable cost to be incurred by him. So for the lessee, it was pretty simple, any one of owns criteria. For the lessor, not only that, but also collectibility and certainty. Now, we looked at the capital lease accounting from the lessee's perspective. So we debited PP&E, we credited lease liability. Simple, easy. Now, from the lessor's perspective, we're going to get this PP&E off and create a lease receivable. So naturally, lease receivable is debit, you're creating an asset, and PP&E is credit, it's going off. Now, the lessee is going to make periodic payments to the lessor. Now, the periodic lease payments that the lessee makes to the lessor gets allocated between lease liability and interest expense for the lessee. We saw that. Now, for the lessor, when he's getting the periodic lease payments in a capital lease, he would allocate that payment between lease receivable and interest income. So it's basically the other side of the coin. For this guy, lessee, lease liability, interest expense. For lessor, the lease payments coming in allocated between lease receivable, so lease payable here, liability here, receivable here. Interest expense here, interest income here. Simple, easy. If you understand, this is just the other side. Now, let's get to our dashboard board there and look at the accounting for capital leases in the books of the lessor. Now, before I move on further, I will talk about two different kinds of lessors, or rather two different kinds of capital leases that you could have when you're looking at the lessor's perspective. First, let's talk about the sales type lease. So let us say we got a manufacturer or dealer who, instead of selling the PP&E, actually leases it out. So let's talk about a car dealer. Now, those guys, they're not having excellent sales. They really want to increase their sales, but people don't have money to buy their cars. So what they start doing is they start giving the cars out on lease to their clients. So instead of selling the car and taking all the cash up front, They give the car on lease and they tell their clients, give us money across or over the lease term. That becomes a sales type lease. So you have, let's say, a manufacturer or dealer who is now the lessor, and they lease it out to the lessee. So instead of selling it, they lease it out. This becomes a sales type lease. Now, a second kind of lease from the lessor's perspective could be a direct financing lease. In that case, we have a bank or a financial institution which buys the PP&E from the manufacturer or dealer and then leases it out to its clients. So let's say you got this manufacturer or dealer. And in the direct financing lease, this guy, he is not the lessor. He sells it to a bank who is the lessor here, and the bank leases it out to the lessee. So you have the manufacturer or dealer as the lessor in a sales type lease. In a direct financing lease, you have the bank which is the lessor. So this one is a financing lease. Now, let's put the journal entries in place, and first I'll talk about a direct financing lease and then I'll expand our example to look at sales type leases. Now, so we have the first journal entry here where we create the asset and the liability in the books of the lessee. So in the books of the lessor, we'll have this asset going out and the lessor would have a lease receivable. So it's just the credit here is a debit here, the debit here is a credit here, because here we are looking at lessee, now we are looking at lessor. So number one, the first journal entry would be lease receivable to PP&E. And this number is the same number. Let's say we've used 10% as a discount rate there. If 10% is also the lessor's rate, then you'll have the same number, 104,247. Now, what you do here is, this is the net number, but the actual amount of lease receivable, the gross lease receivable is 25,000 into 5. So you have 25,000 into 5, the lease payments which are being made by the lessee. It's $125,000, of which 20,753 is going to be interest income. So it's an expense for the lessee, it will be an income for the lessor. And the remaining 104,247, that would be the lease liability here and the lease receivable here. What we do is, instead of recording the lease receivable at net, we record it at gross. So we record the lease receivable at the gross amount of $125,000, which the lessor is actually going to be receiving from the lessee. Now, we capitalize the amount of unearned interest. So we know that over the next 4-5 years, the lessor is going to be earning an interest of 20,753. It's not yet earned, but the lessor, he's going to be earning it. That's why we create this account of unearned interest, a contra asset to lease receivable. And this unearned interest is going to be 20,753. So guys, as you can understand, if I look at the net lease receivable, this is $125,000 minus 2,753 gives me 104,247. So basically, instead of having one account for 104,247, we have two accounts: lease receivable at gross 125 and unearned interest. This number again calculates to 104,247. So that's the initial journal entry that you create. Now here the lessee is making lease payments to the lessor. So the lessor would be now getting in cash. They are paying the cash, the lessor would be getting the cash. So let's do the journal entry for that. So every period, second journal entry, every period a portion of this unearned interest would be earned and the lessor is going to be getting cash from the lessee. So we're going to be having unearned interest to interest income. So if you look at this journal entry here, end of 2011, 12, 13 and 14. So 12/31/2011, 12/31/2012, 12/31/2013 and 12/31/2014. So all these 4 years, the lessee, they have an interest expense. The lessor, they're going to have interest income. So 7925 is I'm using the same amortization schedule, assuming it's the same interest rate also for the lessor, 10%. Next year, 6217. Third year, we're going to have 4339. Fourth year, it's going to be 2273. It's only 4 years because lease payments are happening at the beginning of each period. So that's about the interest income here. And now looking at the lease receivable, there's cash going out from the lessee and coming in to the lessor. So they're going to have cash coming in and lease receivable being credited. So if I look at 1/1/2011, the first day, $25,000 of cash had come in. If I look at 1/1/2012, again the lessor, they received $25,000 of cash. If I look at 1/1/2013, again $25,000 of cash coming into the lessor. 1/1/14, $25,000 of cash once again. And the last lease payments received by the lessor on 1/1/2015, a Happy New Year gift, $25,000. So guys, as you can understand, what we've done here is we've created a gross lease receivable, $125,000, because the lessor, they're going to be getting in $25,000 each period. So they've received $25,000 each period. When we passed the initial journal entry, we already knew the amount of interest income that the lessor is going to be earning over the life of the lease. So we created this account called unearned interest, and every year we debited unearned interest and we had interest income on the income statement of the lessor. So this was 7925, 6217, 4339, 2273. If you total sum of these four numbers is 20,753. So at the end of these 4 years, at 31st December 2014, the number on unearned interest account on the balance sheet is 0. Lease receivable on 1/1/2015 is 0. So everything goes off. They've just had interest income. Now let us get back and do a similar analysis as we had done for lessees. So we had looked at operating lease versus capital lease. So let's get to the dashboard and I'll tell you what I mean. Now in a lessee's case, what we said was, if this was an operating lease, they would have rent expense of $125,000. Even now they have an expense of $125,000, which is interest expense of $2,753 and depreciation of $104,247. Let's do a similar analysis for the lessor. Naturally, if this was an operating lease, this was not a capital lease, any one of these criteria was not met, or there was no predictability of collections, certainty for unreimbursable costs. The lessor said it's an operating lease. In that case, they would have had rental income of $125,000. But then the asset would not have gone off their books. They would have depreciated the asset. The asset was for 104,247. So they would also have 104,247 of depreciation expense. So that would have been the case had it been an operating lease. But this is not an operating lease because we are now learning about capital leases. So this is not the case right now. So once again, if this was an operating lease, the net income of the lessor from this lease agreement would have been $125,000 minus 104,247, $20,753. Rental income $125,000. Depreciation of that PP&E which would not have gone had it been operating 104,247. Net income 20,753. But now it's a capital lease, so they don't have any rental income, they don't have depreciation expense. They just have interest income. And guys, what was the net interest income that the lessor had? 20,753. So guys, as you can understand, the income number for an operating lease and a capital lease is the same. Even here, the expense number for an operating lease and a capital lease is the same. Just that classification gets different. If it was an operating lease for a lessor, it would have been rental income and depreciation. Since it's a capital lease, this becomes interest income. There's no rental income, no depreciation. So guys, that is the concept. That's the line of difference between operating lease and capital lease. And that's very important for you to understand how capital leases impact the balance sheets and how they impact the income statements. So that's the conceptual footing that you need to have. So once again, when you're looking at the lessee's balance sheet, we're creating PP&E, we're creating a liability. When you're looking at the lessor's balance sheet, we're getting the PP&E off because it's going in here and we're having a lease receivable. When I'm looking at the lessee's income statement, there's no longer rent expense. Instead of that, it's interest expense and depreciation of PP&E. When I'm looking at the lessor's income statement, there's no rental income, no depreciation. Instead of that, there is interest income now. The numbers remain the same. Classification changes because it's no longer an operating lease, it's a capital lease. The lessee owns, not the lessor. Get back now. Now the numbers that I've shown you here, I have done a direct financing lease out here. What I've tried to tell you is the PP&E was at 104,247 on the books of the lessor. And when the lessor leased out the PP&E to the lessee, it only had interest income. Now, if it was a sales type lease, let us say again, I'm talking about a car dealer who instead of selling out cars is now leasing out their cars. In that case, there could have been a profit or loss on sale. So let us say, let me use a green pen for this. Let us say this PP&E was at $100,000 on the books of this car dealer. So instead of 104,247, this was $100,000 on the books of the car dealer. And for them, it's no longer PP&E going out. It's actually a sales happening. Where does the remaining 4,247 go? That is the gain on sale. So guys, as you can understand, in a direct financing lease, it's only interest income. In a sales type lease, it's not only interest income. Yes, this is there as it is. Along with that, there could be a gain on sale or even a loss on sale. So that's an important concept, pretty much interesting. Let's get to the book and we'll look at all of this and we'll come back and I have more content to share with you on this lovely, this interesting topic called leases. Turn to page 32 where we're looking at the lessor capitalization rules. Now on the lessor's books, he's going to record the lease receivable net of any unearned interest. Highlight gross investment or lease receivable equals minimum lease payments plus unguaranteed residual value. Within minimum lease payments, you only have guaranteed residual value or bargain purchase option, if any. Now, if it's an optional buyout by the lessee, or let's say the equipment PP&E is going to have some salvage value, that becomes unguaranteed residual value. Next, highlight net investment is the present value of the minimum lease payments plus the present value of this unguaranteed residual value. Now let's talk about the journal entries that we're going to have on the lessor's books. Right, journal entry number 1, get the asset off the books and instead recognize a lease receivable. And on this first journal entry, highlight lease receivable at gross, that's the debit, and on the credit, highlight unearned interest. Now on the lessor's balance sheet, we're going to be reporting net lease receivable. So make a note there, gross lease receivable minus unearned interest, that is net lease receivable. Now the next journal entry is going to be amortizing the unearned interest and receiving cash for the lease receivable. So write journal entry number 2 and highlight amortize the unearned interest. And this amortization of unearned interest results in highlight interest income, which goes to the lessor's right I/S income statement. And highlight the next sub-bullet, do not depreciate as the asset is off lessor's books. Now the lessee depreciates because this one is a capital lease. Though the lessor owns the PP&E in form, in substance the lessee owns it. Make a little note at the bottom of the page, write lessor income on income statement. Operating lease, the lessor has rent less any PP&E depreciation. In a capital lease, the lessor has interest income. Moving to page 33, we're looking at the example on capital lease. We're talking about the accounting by lessor. So the first part, we're talking about, put a box around sales type lease. And looking at the journal entry there, we have lease receivable at gross $125,000, unearned interest $20,753. Put a box around both these numbers and write net lease receivable equals $104,247. Now on the credit where you have equipment, make a note, off the books. So the equipment is off the lessor's books into the lessee's books. And because this is a sales type lease, you have highlight gain on sale. Now I want you to draw two arrows here. First arrow, draw an arrow from unearned interest to the unearned interest debit amortization on the next journal entry. Draw another arrow from lease receivable to the third journal entry where the lease receivable is being realized in cash. So as you can understand, the first journal entry, we are having a lease receivable and the equipment is going off the books. There could be a gain or a loss on sale. Next journal entry, we're looking at amortizing the unearned interest, which results in highlight interest income. The third journal entry is the realization of lease receivable. Now the second part we're looking at, put a box around direct financing lease. And make a note there, no gain on sale, only interest income. So in case of a direct financing lease, the PP&E was on the lessor's books for 104,247. The lessor did not make a gain on sale, but he's still going to have interest income as and when the unearned interest is being amortized over the lease life. If you recall, we talked about initial direct lease costs and executory costs when we did operating leases. So initial direct lease costs could be broker commissions, legal fees, document preparation, basically expenses incurred by the lessor or the lessee when they entered into the lease. Now, in case of an operating lease, we saw that the lessee expensed such costs in the first period. The lessor amortized those costs over the lease term. Now, in case of a capital lease, the lessee would continue to expense it. So, initial direct lease costs are always expensed by the lessee. For the lessor, in an operating lease, amortize straight line over lease term. In a capital lease, if it's a sales type lease, the lessor would expense it in the year of sale. It could be COGS or it could even be selling expenses. But if it's a direct financing lease, again, the lessor is going to amortize it. What he's going to do is, he's going to add the initial direct lease cost to the net lease receivable. So naturally, when he's getting the lease payments, those lease payments get allocated between lease receivable and interest income. So if lease receivable is higher, naturally the interest income would be lower. So in that way, the initial direct lease costs get amortized over the lease term. So guys, once again, initial direct lease costs for the lessee always expense. For the lessor, expense if it's sale type lease. If it's operating lease or a direct financing lease, in that case amortize. Now that was initial direct lease costs. We also did executory costs, something like property taxes, repairs and maintenance, insurance. Now such executory costs, whether it's the lessee or the lessor, expense as incurred. On page 34, we got a lovely table where we are looking at the financial statement elements in accounting for highlight capital leases. So now we're trying to understand what's happening on the lessee's books and on the lessor's books. So looking at the balance sheet. Now, in case of a capital lease, we know that the leased asset disappears off the lessor's books and reappears into lessee's books. So for lessor, I have scratched off leased asset right there, off lessor's books. And for lessee, where you have leased asset, right into lessee's books. Now, as the leased asset is going off the lessor's books, the lessor now has a lease receivable. In a sales type lease, the lease receivable is net of unearned interest. In a direct financing lease, you add the initial direct costs of the lease to lease receivable and then net it off unearned interest. So underline add initial direct costs. For the lessee, you have a liability also on the balance sheet, which is the lease liability. Now looking at the income statement. So for lessor, in a sales type lease, there are two profits, two income. Interest income, highlight, and dealer's profit on sale. In a direct financing lease, the lessor only has interest income. Now for the lessee, it's interest expense, it's depreciation expense, and any executory costs like repairs and maintenance, taxes, insurance, etc. Now looking at the initial indirect costs for lessor, in a sales type lease, underline initial indirect costs expensed immediately. And for a direct financing lease, underline amortization of initial direct costs. Now move to page 35. And if you think this concept of initial direct lease costs is trying to challenge you, I'll make it very simple for you on this page. Now when we're looking at those initial direct lease costs, highlight incurred by lessor, try to understand what kind of a lease it is. If it's under an operating lease, right, amortize. If it's underline sales type lease, right, expense. If it's underline direct financing lease, right, amortize. Now if the initial direct lease costs are highlight incurred by lessee, right, expense. Now the second half of this page, we're looking at executory costs, recurring expenses like repairs, maintenance, insurance, taxes. Executory costs are an expense both for lessor and lessee. So write there expense. Now capital leases under GAAP are called finance leases under IFRS. Now for leases, there's a little difference between GAAP and IFRS, and this relates to what I taught you in FAR 1. If you recall, I said US GAAP, that's pretty much rule based. It tells you exactly how you're supposed to be doing your accounting. So for instance, let's look at this capital lease criteria. Now US GAAP is very specific. It tells you you can classify a lease as a capital lease if the present value of minimum lease payments is greater than or equal to 90% of the current fair value. Very specific, 90%. Or if you're using the asset for 75% or more of its economic life. Again, very specific, 75%. So rule based US GAAP. Now IFRS is more principle based. So IFRS says you got to classify a lease as a capital lease if the lease transfers substantially all of the risks and rewards of ownership to the lessee. So IFRS does not use 90% and 75%. They say the lease transfers substantially all of the risks and rewards of ownership to the lessee. So that's the principles based IFRS. Difference between GAAP and IFRS for leases. On the second half of page 34, we're looking at circle finance leases. Now this is the IFRS terminology for capital leases. And right there, similar to owns criteria, but more judgmental than specific rules. So IFRS says that both lessee and lessor should classify a lease as a finance lease, highlight if the lease transfers substantially all the risks and rewards of ownership to the lessee, and highlight no specific criteria. So you don't have the 90%, 75% specific criteria, it's more judgmental. Is the lease transferring substantially all of the risks and rewards of ownership to the lessee? If yes, it's a finance lease for both lessee and lessor. Next bullet, highlight lessor and lessee generally classify a lease consistently as an operating lease or a finance lease. So it's either an operating lease for both lessee and lessor, or it's a capital lease for both of them. But under GAAP, so right, under GAAP, lessee criteria equals owns. Lessor criteria equals 3 C's, which is owns plus C plus C. Now, so under GAAP, there could be a case where the lessee classifies a lease as a capital lease and the lessor still accounts for it as an operating lease, which is not under IFRS. Now, often companies want to move from an asset heavy model to an asset light model. Okay, let's say I've got a warehouse worth $1 million. So that's a lot of cash which I could have used to expand my business. Now, you would advise me to sell the warehouse, but I can't operate without my warehouse. I store all my goods there. If I sell the warehouse, where do I store my goods? Now, in such a case, I could go for a sale lease back. So what I would do is I would sell the warehouse to a buyer and then lease it back from him. So guys, I am the seller and the lessee. The buyer becomes the lessor. Now this serves both my purposes. Number one, it gives me cash to expand my business. And number two, it allows me the continuous use of the warehouse. Guys, note that there are two transactions happening here. Transaction number one is the sale, where I am the seller selling my warehouse. Transaction number two is the lease back, where the buyer becomes the lessor and I become the lessee, leasing back my own warehouse so that I can use it. On page 36, we're looking at sale leaseback, where property is sold by the owner and immediately leased back, such that the original owner or seller does not give up possession or use of the property on the sale. So we know that the seller in a sale leaseback is the lessee, the buyer is the lessor. So the seller highlight transfers ownership of property, and then the buyer lessor highlight retransfers right to use. So you have a sale and a lease. This is right, two separate and distinct transactions. So to move from an asset heavy model to an asset light model and to generate cash to expand my business, I sold off my warehouse and leased it back. Now the question that I have for you here is, what do I do if the carrying value of my warehouse when I sold it is different from its fair value, such that I have a gain or a loss on the sale of my warehouse? Now, if I have a loss on the sale of my warehouse, then it's simple. I need to recognize all the losses right today. We're conservative accountants. Losses, we don't defer. It's right now. But if I have a gain on the sale of the warehouse, I first have to understand whether the lease back, so it's a sale lease back, so whether the lease back that I have done, is it major, middle or minor? So let us say the fair value of the warehouse that I sold was $1 million, but the carrying value on my books was just $300,000. I made a $700,000 of gain on the sale of my warehouse. And now I lease back the warehouse for the next 50 years, such that the present value of my lease payments is $950,000. So guys, the fair value of the warehouse, that's $1 million. The present value of the payments that I'm going to be making over the next 50 years is $950,000. That's more than 90% of the fair value. This is a case of a major leaseback, and in such cases I need to defer all of the $700,000 of gains. I don't recognize any gains today. I defer it. It's recognized over the lease term. So this was major leaseback. Now, second case, let us say I lease back the warehouse for the next 20 years and the present value of my lease payments is $600,000. Now this is 60% of the fair value of $1 million of the warehouse. Now 60% is less than 90% but more than 10%. So this becomes a middle lease back. Now, in case of a middle lease back, the rule is that I need to defer gains up to the present value of lease payments. So in this case, the present value of lease payments was $600,000. So what I would do is I would defer $600,000 of the gains and I would recognize only $100,000 today. So I had 700 gain, of which 600 up to the present value of the sale lease back I'm going to defer, 100 I'm going to recognize right today. This was the case of a middle lease back where the present value of my lease payments is more than 10% but less than 90%. Now the last case, the third case, let us say if I lease the warehouse back for 1 year only such that the present value of my lease payments is less than $100,000, less than 10% of the fair value of the warehouse. Now this is only a minor lease back. So in cases of minor lease back, I can recognize all of the gains immediately. So I would recognize all the $700,000 of gain right today. So guys, quick recap. Sale lease back, if I have a loss on sale, recognize it today. But if you have a gain on sale, need to consider whether it's major, middle or minor lease back. If it's a major lease back, defer all the gains. If it's a middle lease back, defer gains to the extent of the present value of lease payments. If it's a minor lease back, recognize all the gains today. You're done. Back to page 36. We got a table comparing the criteria and accounting for all the types of sale lease back. Now this could be, put a box for major, it could also be box middle, and the third one it could be, put a box around minor. Now it is a major sale lease back if the present value of future lease payments is highlight 90% or more of the fair value. Now in this case, the N of owns criteria is always met. So this one is highlight capital lease. Now for a middle sale lease back, the present value of future lease payments is highlight less than 90% but greater than 10% of the fair value. Now a middle sale lease back, here the lease could be highlight capital or operating lease. In case of a minor sale lease back, present value of future lease payments is highlight 10% or less of the fair value of the property sold. Now the lease classification would generally be highlight operating lease. Now the question is, what do you do if you have a gain on the sale? So the seller lessee, if he has a gain on the sale and it's a major sale lease back, he would highlight defer all gains, which would be amortized over the lease back period. But if it's a middle sale lease back, the seller lessee would highlight defer the gains up to present value of the lease back. However, if it's a minor sale lease back, then the gain would be recognized immediately. Highlight that. Now from gains, I want you to draw an arrow down and write gain on sale is offset against future lease expense if major or middle. But if it's minor, the gain on sale is recognized immediately. On page 37, we got a comprehensive example on sale leaseback. It says on 1st Jan 2010, Shipping Corp sold a ship with an estimated useful life of 20 years. Now Shipping Corp simultaneously leased back the ship. So guys, this becomes sale leaseback. The sale price of the ship at fair value was $925,000, but the carrying value, that was only $200,000. So this means that Shipping Corp had $725,000 gain on sale. The monthly rental payable by Shipping Corp, that was $10,000 per month. Now we're going to look at three cases here. The first case, we'll look at if leaseback period is 6 months. Second case, we're taking the leaseback period to be 3 years. And the third case, we assume that Shipping Corp leases it back for 15 years. So the first case, lease back period of 6 months, we already have the present value number of lease rentals for the first 6 months, $58,000. Now $58,000 is less than $92,500. $92,500 is 10% of the fair value of $925,000. So the first case is a minor sale leaseback. Put a box for minor and write gain on sale recognized immediately. So the $725,000 gain on sale by Shipping Corp is recognized in year 1 immediately. Shipping Corp would be paying rental expenses for the first 6 months. That calculates to be $10,000 per month into 6 months, $60,000. Now the next case, we're looking at leaseback period 3 years, where the present value of the lease rentals calculates to be $301,500. Now this is more than 10%, more than $92,500, but less than 90% of the fair value, which calculates to $832,500. So this one is classified as a middle sale leaseback. Put a box for middle and write gain on sale equals defer up to present value of lease payments. So the gain on sale of $725,000 is deferred up to $301,500. The balance is recognized immediately. So looking at the calculations there, sale price $925 less carrying value $200, gain on sale $725. The present value of lease rentals $301,500 and the balance $423,500 is recognized immediately. Highlight $301,500 is amortized over 3 years, the lease back period. So every year Shipping Corp is making annual rental payments of $120,000 at $10,000 per month. The $301,500 now reduces this rent expense. So $301,500 when you amortize over 3 years, it's $100,500 each year. So the rent expense for each year is basically $120,000 less $100,500 amortization of that gain calculates to $19,500 each period. So right there, operating lease equals deferred gain reduces future rent expense. Now in the third case, we have the leaseback period of 15 years and the present value of lease rentals $833,000 is greater than 90% of the fair value of the ship. So this becomes a major sale leaseback. So put a box around major and write gain on sale defer all. Highlight the gain $725,000 is amortized over 15 years, the lease life. And right there, capital lease equals deferred gain reduces future depreciation expense. So the amortization of this gain of $725,000 reduces the depreciation expense that the Shipping Corp has on this capital lease. Now that we've talked so much about leases, let's look into subleases where the lessee sublets the PP&E. So guys, on the sublease, the lessee now acts as a lessor and you have a new sublessee. Now in cases of sublease, you need to remember that if the original lease between the lessor and the lessee was an operating lease, even the sublease is treated as an operating lease. Now, if the original lease between the lessor and the lessee was a capital lease, but due to N or S criteria, even in that case, the sublease is treated as an operating lease. But if the original lease between the lessor and the lessee was a capital lease due to the O or W criteria, only in that case the sublease is treated as a capital lease. On page 38, we're looking at subleases. So this is when the lessee sublets a leased property to another sublessee. Now this has no impact on the accounting of the original lessor, and the sublease classification by the original lessee and the sublessee depends upon the classification of the original lease. Highlight: if original lease equals operating lease, then sublease is also an operating lease. If the original lease was a capital lease due to O or W criteria, then the sublease is also accounted for as a capital lease. But if the original lease was a capital lease due to the other criteria, the N or S criteria, and does not meet the O or W criteria, then the sublease is accounted for as an operating lease.